Hello, everybody. Brian here from quantlabsnet.com. Today is 17th of April. This video, again, reinforces the importance of this futures options set of reports for not just anybody, but specifically for higher net worth. You could also, individual trade in this space. Also, it's helpful to see the importance of the multiple instruments here. Here we have 39. I'm going to add some more for the Japanese yen, euro, and all the crypto that's available on the CME. That's Bitcoin, Ethereum, Solana. The whole purpose of this is to give you a synopsis on being able to trade safely, forecast with these reports, just give you a better idea on why this is and the big benefit that comes with it. This video is fairly lengthy as usual because you'll see the reports. Each one of these has about 40 to 50 pages each, constantly evolving, and it's very detailed from a institutional point of view to learn for potentially a career in this space, which takes you into the seven digits. And this is, if you don't understand the complexity of this or appreciate it, I would not go into this space as a career because this is what these folks do for this type of money. Another thing is to consider in this video, there's two sections after this one. The first 50 minutes basically goes through all the detail. I also did a 2.5 hour video webinar on this exact topic with a live audience. So I've pretty well got now 4 to 5 hours of this content. And after the 50th point of the next video segment, I go through to showcase the advantages of a few things here. CL and ES futures, which are the two most popular traded. But what most people should realize, if you want to stay safe in this industry and make money, especially in volatility, I purposely bring up two further ones that are uncorrelated to, as I keep saying, U.S. assets because of the crazy tariff trade wars are about to start and have started. Most professional traders will look for uncorrelated to dollar, the treasury market, U.S. Stock market as well. And the examples I've given here is orange juice and I believe lumber. They're doing fairly well now. Or orange juice was doing well, maybe doing well, may have come up. You can see in the reports what I'm talking about when you get to that point. After the 50, that's the last segment of the video. So the next videos, segments, 50 minutes and another 10 minutes to showcase those multiple types of reports. Let me know what you think. And also, if you want to be part of this project we got on to see these reports to qualify them, I'll put the forum link as well to be part of that as well. Thanks for watching. And if you want to know more at the end, you'll see you can join my email newsletter for the see the progress of this because this is really helpful. And from what I'm seeing, there's nothing else out there like it. And hopefully people appreciate the value that this brings. Hey everybody, Brian here from quantlabsnet.com. Today is April 17. Just wanted to go over trying to do a condensed version of what I put out a few days ago with a webinar, 2.5 hour video, plus talk about progression of these so-called reports for options and futures trading. And I just wanted to go over what I'm referring to. So if you're coming to my channel at Quant Labs, and a couple things you might want to know is I first fired off this video here called Analyzing the Gold GC Futures and Options Report Key Takeaways and Insights. Then I came up with a 2.5 hour video webinar to a couple of people, live audience. This video called Master Commodity Futures and Options. Okay. So then I followed up with video on this. I mean, I've got tons of articles, deeper analysis articles. So if you're not following these reports Uh, this is why companies like Renaissance Technologies, otherwise known as Rentec, where their brain broke and they lost quite a bit of money on their traditional way of trading due to the tariffs and whatnot. Another story I put out there was that Man Group out of the UK was also affected by this as well. So basically, what I'm picking up from researching it is because they're not following the safety guardrails that the firm should be setting, and they're just taking on leverage trading, and they're losing big time on this because they're not following through on what is available on what's available to them. Everything's changing really quickly in the world of trading due to AI, software generation, code generation, otherwise known as vibe coding. Um, and right now I've got a set of reports I'm going to show you, but if you come under my forum on the quantlabsnet.com/forum, come into the general discussion, all you got to do is look for this article right here. Um, Call for elite traders. Okay. That will go over what's needed if you want to be part of this team that I'm putting together to validate the reports I'm about to show you. So again, this is the condensed version. In here, things have radically changed since I put up the last set of videos. If you go in here uh, in the report section, what I want to show you that's really important is we've got 39 available reports. Does not include new ones that I'm going to add in for crypto that are traded on the CME like Bitcoin, Ethereum, and Solana. It does not include euro or euro dollar and now soon Japanese yen. So this is where a lot of the investment's going because hot money, hot capital flow does not want to be attached to US Treasury, US dollar, and specifically US markets. So now we have the ability to focus on uncorrelated assets in the futures market and futures market, options and futures market combined in these reports. This is more of a unified way of looking at the different opportunities out there from these assets. So again, we're now at 39 and more to come. Okay. So knowing that, let's take a look at some of the reports. So the popular ones are going to be the ones like, and again, these are all in development. So what you see may not uh, be accurate because these are in testing. That's what this group is about. Um, but if I wanted to show you these are Word documents. These will soon be converted into PDF format, but for now they're in Word. But eventually they'll be moved over, converted over to PDF. So here, a couple of highlights that I've added. The big one is the annual volatility of these particular assets. So in this case, this would be oil. And again, when you see these numbers here, these might not be accurate. That's why I'm putting together a group to help validate all of this stuff. But just generally, for oil, let's say 25% volatility is quite high. Most people may not want to trade that right now because it's too volatile, too unpredictable. Out of that, we want to know things using Black-Scholes. If you know about options trading, the standard um, one for calculating uh, things like put, strike price, futures price, the underlying, and different measurements of the expiry before um, the option expires, and a standard risk-free rate as well. This could be considered implied volatility. And then you start looking at the charts here. This is just the futures price. Okay, so just as an example here is using ARIMA, and you can see here, this is a little prediction here from the ARIMA model that you can use as, as well. A couple other things are highlighted here. That's really important to understand things like when it comes to correlation, namely for both, again, simulated pricing from the options market, but it's all simulated, as I said, and I've hammered it home now over the last couple of, well, week or so, that this is simulated data for the options chain, but this is a critical sensitive part in how to calculate um, your best ability on the options pricing from the options chain for both the put and the call. To get real data, it's very expensive, a couple thousand per month, and it's purposely that expensive to keep the retail traders out. And it's heavily protected by the exchanges like the CME. And believe me, on the lobbyist point of view, they want to keep it that way. So unless you're pay to play for a few thousand, you won't get access to this. But this is simulated as best as we can so far. So the thing is, this is fairly advanced stuff. And again, we're measuring the standard deviation of cash returns, future things like that, correlation as well. Sorry, correlation coefficient between, or if there is a relation between the cash and futures market. Um, just so you know, as part of the debugging and validation process, many assets out there, namely, I don't know, as an example, we know there's a spot market for gold. We know there's a spot market, or sorry, a futures market for oil, gold, even some of the metals like silver and the like. But when you move into things like corn or even more specialized like cocoa, coffee, that can perform really good in these kind of markets that we're in, the market conditions, they may not have a reflective spot market. So I have to build in the intelligence to not measure cash market or spot market because there's nothing equivalent for that. So I have to uh, put some intelligence in there. So it'll be just purely futures and options. Whereas some other markets, like as I said, again, like with what I've already mentioned, plus the markets themselves, like Nasdaq, S&P 500 have spot markets as well, and the futures, and you can build an options whole set of data from that. So when it comes to simulation with the AI, because this is AI generated, even the code is AI generated. And there's different ways to build out the simulation using auto-loaded. Once you get data from that, you can now start to build out further simulated data as well, using simulated things for uh, call applied volatility, put implied volatility as well. And that's important because that helps you gauge the risk you want to take on anything in the future. Um, and from what I've seen and working with the reports so far in all the spaces, as I said, we've got now currently 39 and more to come. I'm understanding each and every one of these markets are totally different, have a different set of attributes and dynamic features that's very unique to those markets. And there's certain market classes within the futures market. There's some kind of relationship as well. You want to understand that correlation as well. But as you work with it more and more, you start to see it as well. So as I said, there can be a futures price, and then out of that, which is set by the exchange of the strike price, and then we are nothing but running simulations to find our optimal opportunities when it comes to the hedging on an entry or an exit or long short, whatever the side is that you want to take on. And then we get into the market call price and these market call price and the market put price. Again, remember, this is all currently simulated. So then again, we can have, when you build out an options chain that's simulated, we look at the different strike above, strike below the current um, so-called strike price as if it's calculated by an exchange. And then there's also the question of how far out will our expiration be? Usually, from what I've seen, it's going to be anywhere between 1 to 3 months for optimal forecasting, and out of that, we can generate a call status if it's in the money, out of the money, and figure out what they call the moneyness in the options market, which is basically another way of saying your profit as well. To generate this type of data for the detailed option chain, which is again generated from simulation from a strike price. You can determine your Greek analysis, which factors in your rho, theta, vega, gamma, and delta. And that's where I think, from what I'm talking to real world profitable futures traders that only do futures, there's a reason why they don't want to go into options is because of this Greek analysis that really throws down the complication on that. But yeah, I thought, well, wouldn't it be neat if there's some kind of report or some kind of spreadsheet that can make it a lot easier for them to gauge these sort of things? All right. And then when you go deeper into these reports, you can see the simulations that come out of it and being able to measure uh, a put option, sorry, a payoff on whatever side you're on, combine it with a real option or set of options, and you get synthetic options, combine it with a floor price as well. Kind of gone through that in the 2.5 hour webinar. There's just so much information here. It's hard to sort of summarize it. So again, we were looking at the Greek analysis. Most people will look at the delta, which again is a measure of change in option price for every dollar change in the underlying future price, right? So we could have a negative, positive delta. We can also look at the gamma. We can look at the theta as well as the vega as well. And funny enough, there's different strategies that you can do, like gamma, um, gamma. Oh, I can't even remember the name of it. It'll come to me at some point. There's just different ways of trading at a high frequency level, like what high frequency trading does, and all different ways to trade from this type of data. And again, this is forecasted data. Like when you get your hands on real, true, valid option chain data, the game changes because now you're trading in with the big folks out there. As I said, this is worth a lot of money. And providing reports like this, once it's built around real world option chain data, this information it just magnifies in value by times 10, maybe times 5. I don't know. Hard to say. But it would be very expensive to generate this. All right. So again, if you're interested in this, I do have a course built around this. It's fairly advanced, 5, 6 week course. It's drip fed on purpose because you can see how quickly you can get overwhelmed here from all the different ways of analyzing these markets. And that's why it's a derivatives market, because there's so many multiple derivatives that come out of this. So again, one of the key areas for market opportunity that a lot of the hedge funds, high frequency shops will look at are the basic call put parity in the option space. And when they say it's efficient, meaning that your calculation here on your call put variance with the strike price and the put and strike price are in balance usually. I'll show you some other tighter ones. This is obviously a bug, as far as I'm concerned. But if this was real and you did see your value be this kind of amount of discrepancy, this right here would be your opportunity to trade in the option space to arbitrage and or hedge that to virtually profit in an unlimited way. So I understand this helps you to get a job and a career in this space. And everyone goes on about things like uh, quant researcher, where they think that the half a million dollar packages are paid out. That's not true. If you're a quant researcher and you take it to the next level to be a portfolio manager, especially out of London, if you've seen my recent 5 hour video looking at different jobs in the quant space from places like Australia, Singapore, Hong Kong, UK, and US, you'll see that some of these positions in portfolio management pay well into the millions. And they don't really care about your education. They don't care about your age. All they care about is you have a valid, proven track record. And if you're interested in knowing that, this is where you learn. Knowing this stuff, because this is what most of these trading firms trade in the futures and the options space. And I put up another article on that of a former aviation engineer who made Ooh, I think probably packages of over 500,000 with with a small Chicago proprietary firm. All right, so continuing along, as I said, we have the call put parity, which is important. I'll show you some other ones, but this is kind of like generally what they look at. Also, they'll look at their risk frontier using this information to gauge their optimal portfolio. And everyone has their own definition of portfolio. If it's in the um, if it's a portfolio for a certain type of asset or asset class or an entire portfolio. And believe me, I've got lots of data to work from there on however you look at a portfolio. And again, you can see here the expected return measured by risk, which is really your standard deviation. And it gets very mathy, especially on the hedge fund, the hedging math right here, or if you want to look at the Greek um, analysis as well, when you look at the science they call it notation with all the formulas you see in the world of quant, and understanding that is important, obviously. But with AI now, where it's at, being able to know what to prompt in an AI LLM and be able to work with the option of the results that comes from both the code, the math, and the formulas you give it, and the combination of that, being able to reverse engineer that, it's just it doesn't matter what the market conditions are. The world is your oyster. So let me go into the more critical that a lot of people don't pay a lot of attention to are your payoff diagrams. Again, generally this is what they look like. So here you'll have your underlying future price, and that could be your minimum risk you take on. And then here you could have, in this case, a long call payoff, which is virtually unlimited. Here your profit loss right there. And you can also see your strike price and your break even. And this helps you measure your break even at what point you need to start saying, okay, I'm going to make zero risk, zero profit, yes, but if it goes your way, um, you can set up positions or basically a combined strategy of positions where you can put on leverage if you're cool with that and be able to do it in an unlimited way. Especially in these markets, I'm sure a lot of people are making a ton of cash with the crazy volatility. So this is the important factor here. Um, the different type of option strategies you have, as I said in my webinar. Um, these are your different option strategies you can use. Long call options. Some of these are kind of messed up as well. I have to put in intelligence to make sure they are valid or not, and only display the valid ones. So again, this is a long call option. You have a bull call spread. Um, you can have a bull put spread for shorting, depending again on the side of the market. And again, if you expect bearish conditions, you can use things like long put option payoff diagram or say like long put options. You can also use bear call spreads, bear put spreads. And then there's a lot of talk about market neutrality or uh, neutral market. Sorry, neutral. Yeah, but basically market neutral. So here we could deal with short straddles, short strangles, and it gets more complicated as well, as you'll see in the diagram where it's really messed up. More parameters to work with and simulated different span periods of time on a call or a put with different strike as well. So there we could calculate and project calculated iron condor. Yeah, it doesn't look so bad. And do the same thing with an iron butterfly as well. Different sets of parameters here. What are different premiums as well? That's not too bad. And then we have our standard hedging strategy. If you, and a lot of it has to do with what's the size of your account and the kind of risk you're willing to put on per trade. So you have a cover call payoff, uh, protective protective put as well, and here a caller as well. And then part of what we're trying to do here, essentially, with these payoffs, is to figure out what's our premium going to be, what would our max price be if we were to trade at this strike price. And then here you get a standard uh, price right here, could be a future, and here could be your cash position as well if the future underlying market moves. And then again, using this strike price as well. Where it gets very interesting is where you can take these kind of payoffs and put them into a 3D as well. You can see better visualization. As I said before, there are charting software that I'm working with from the vendor to be able to demonstrate that with you. It's very impressive, very quick, and for simulation purposes, it's really, really powerful. Again, here, this is where the messed up part comes in with a payoff analyzer. We can have a simulated entry price, a strike price, what are called premium B. Okay, not great looking. Same with a put option, and then a call option. So that's both sides of the trade for a short or a long as well. All right, so then we can also do the cash as well, and so on and so forth. And again, we've talked about arbitrage. Here we can simulate different types of arbitrage on a potential future P&L if we use a future contract along with a short or a long put, or sorry, short call, long put, what's our P&L for that, and then do a combined net P&L between the future and the options as well. Okay, same here with the arbitrage opportunity. You might have storage costs like classic oil if you're coming in from an institution or a producer. So you have to factor that in. We also have, again, what would our strike future price be? What's our current price? We buy at the current cash, sell at the future, da da da. What would our potential arbitrage be? And from there, again, this is using standard AI. If there's an arbitrage there as well, and we could play all these different scenarios as well, different parameters for both the cash price, the future price, cash position. Because another factor, and a lot of people don't factor in, is what's our contract size, what's our unit size, and that can have a factor as well on profit as you scale up your trading position. So again, what would our total cash outlay be? What would our projected future revenue be? How many contracts do we need? And if we have a converged pricing as well. And then again, we can look at what's the potential overall profit and loss. And again, with that, would there be an opportunity as well? And again, there's different scenarios you could run. And what's the size of the contract is a factor to set as well. And variety of different scenarios we could look at as well. And again, we could feed all of that data back into a AI and be able to customize a pricing engine from that, knowing the data that we expect on these different pricing targets for both the futures and the uh, options, and be able to generate a pricing engine from that. And that could be in your language of choice. It could be C++, it could be in Java. It could be in Python. And the funny enough is a lot of these AI LLMs, the ones that I've identified, they're so advanced that they also have the coding for your software development kit for the exchange or the API for the exchange, if it's the CME or whatever. And some of the coding I've seen also enables you to see what coding is needed for the not just the API, but it'll also include the quant math and the targeting as well, and all the automated position as well. So you can build out a complete matching engine along with the order execution as well in those languages that I mentioned. It's that advanced. Again, here using these different types of data points, you can feed it back into an LLM and basically have a chat and develop history from that and be able to have it know all the different scenarios you want and feed it into uh, an LLM. It's beyond impressive. And as you see here, you can set your pricing boundaries. And this is, as I said earlier, your guardrails. It's so important so you don't fall into the traps of what the Renaissance technologies did or the man group fell into because they didn't set these boundaries. It's so important to set these boundaries as your guardrails to prevent you from over leveraging or for taking on too much risk because you're outside of the standard risk that you want to set. And the other funny thing is, there's only a certain trading zone you want to trade within using these layered positions. Okay, that's why you want to have the custom pricing engine for this or a matching engine. And ideally, you want to trade within this little put option area right here, depending upon what kind of option, call option, or put option, and only trade within this range so that you know to get in or out. And if you're lucky, here's your range as well on your call and min-max tolerance to get that maximum profit. And again, this could be on a long. You could also do the same thing short, and because you have now the data, you could feed that back into an LLM for your own pricing engine. It's that advanced. And then again, we can factor in the arbitrage that would go with that, and also we could factor in your hedging as well. So you can use your basis calculation and then figure out your tolerances on what you want your basis to be on your target future price or entry point for those future prices. If it's a cash market or for a future price as well. That's how advanced this is. The more important thing is if you are planning to hedge, you can again use how many units would you need to buy of, and I say units, it could be barrels, it could be bars, gold bar, whatever the contract is, you're measuring barrels per day, uh, gold bars, ounces, whatever the measurement is, and obviously you have to add in uh, further, more complicated um, measurements as well. If it's, let's say, treasury or you're buying yen, there's some other further calculation you need to do. I'm only showing you the straightforward stuff like oil, uh, and I'm going to show you the ES as well. That's usually traded and gold because you don't have to deal with the other complicated stuff if you wanted to trade things like euro dollar, or treasury, or Japanese yen, because there's some further unit calculations you need to make. But for those that are small accounts, you're not going to do those type of trades because those contract sizes are huge, margin requirements huge, and usually they're big enough so that you won't take on the margin risk that comes with it as well. Or maybe the premium that you pay out is going to be too high. But it can be done from an institutional level, namely, as well. And having this data available to you, especially from an LLM perspective, you have that history, and the way I do it, you can bounce from one LLM to another to continue very complicated pricing engines or pricing analysis that I've shown a video. Actually, I should see it on this one video as just as a simulation. I put this up on purpose just to show you what you can do with this stuff. So again, I hope there's no ad. Oh, thank you. Oh, no. Let me just see if I can silence this. Um, okay, I'll bail out of this. Okay, so we could skip here. This is the video I put out. So this video is just a demo what you can do using Python. So if you wanted to do live 3D charting with bid ask engine, you can do that, and you can actually do it live with live refreshing as well. This is just using um, a standard open source set of solutions. But if you went with a third party um, uh, expensive option, you can do that, or package as well with more advanced options. So that's where this sort of thing can lead to having these kind of analysis available at your, I won't say fingertips, but um, just having this available to you, it's a different time now moving forward for doing this kind of research, pricing, and actually live trading with it. And it gets more sophisticated as well. These are just samples of what can be done out there with these type of information here. So as I said, when it comes to hedging, it gets so advanced now you can just do your basic hedging risk. But where it gets really, really, really good is using, again, quant, using optimal hedging as well. What's our cash position needed for whatever contract? What's our future position needed to be? What would our expected cash return and expected future price? And you can see here, this is using again the standard notation to be able to calculate what would our risk parameters need to be for both the variance on the cash price, the variance on the future price, and the covariance need to be to achieve what we want is our optimal hedge ratio. Okay. What would we need to be to get to that point of optimal? Okay. What would our optimal future price need to be? What would our hedge portfolio need to be? So on and so forth. This is really important for when you have larger accounts, or especially when you are a trading firm, to be able to do this within the safety, the guardrails I've talked about and the boundaries of what your parameters should and shouldn't be, and being able to reduce the risk, have actual minimal risk, and be able to calculate what you need to be in. Okay. And again, using AI to co-generate things, it's really impressive with that one video I just showed you. And again, you can use the the hedge ratio calculator as well for that to be able to say, okay, what would our impact be on the hedge ratio if we're profitable? How many contracts do we need to achieve it? What's our trade-off going to be? Do we need to use better protection, more protection on the future price, which is at a higher cost, but it limits upside, or do we take on to lower our costs? We need to factor in, do we take on less protection with price drops? And again, you can quantify it from all levels, from your optimal trading as well. Okay, so you have here your basis risk as well, which is what people are talking about on the treasury side. Will the treasury market in the US blow up? And you can do that type of analysis if you can get your hands on the option chain data for the different durations of the different treasury markets, coming from the Fed, obviously, and seeing what institutions are doing as well in the options chain data. It reveals so much information, be able to quantify that risk and when it will it blow up, so on and so forth. And that's why, again, I keep saying that is so valuable, that information, right? So are we dealing with narrowing basis? Impact is better for short hedging. And then there's that relationship. Future price goes down more than the cash price. Hedging becomes more valuable if we have a widening basis where we have negative for short hedging. Cash price goes down, futures price goes down, and then the hedge provides less protection. That's the sort of thing that AI will give you so that you know what to do, when to do it, know to set the targets, and know the risks, and know the pros and cons of each. So we're also, with simulation, is to be able to find the perfect hedge. Can you imagine that? All of this just in one market, using the CL. Okay. If the price falls below 60.97, you still pay 60.97, so on and so forth. But this is just using simple AI, things that you never would have thought about as an individual trader. But you're expected to know when you go into these large trading firms and get your million plus packages, especially if you want to get into the portfolio management side. So learning this here, using these kind of reports are very valuable. But what makes it more important is to be actually an actual trader with the experience and to actually have, from what I've seen from the high paying portfolio management jobs, having 2, 3, 5 years of portfolio management skills is one thing, but the important thing is to have your track record to show you're a consistently profitable trader. And when you go into these firms, you can explain why and how, knowing all this information, be able to provide this as well. And again, we're just approaching, just peeling back the onion, what's in the onion, and we're probably two-thirds of the way now, right? So again, when it comes to things like futures hedging and call option hedging, there's the price protection, the advantages and the disadvantages of each when it comes to upside, downside, upside potential risk, downside risk, the cost, the flexibility that comes with it, and the margin requirement. Essentially, what this is, if you're a futures hedging only, do understand you're locked in at a price. Your upside is totally eliminated. You don't have any uh, downside risk. Well, downside risk is eliminated. Your upside potential is risk, which you don't want, but your downside risk is taken away because you're dealing with a futures contract. Um, you do have lower costs when it comes to futures, but again, you have uh, you're bound to your obligation with the free futures contract. And if you do decide to take on margin, it's higher. Whereas where 80% of people, professionals at an institutional and smart money, about 80% will take on more options and only use the futures contract to minimize their downside risk. Whatever, if they're longing, shorting, buying buying options or selling options. So they that's the only thing they use the future for. But where they really can benefit is when they do call option hedging, or if they're on the other side to sell a option as well. This is most people fall into the call option hedging or being a hedger, being a speculator. So here with the price protection, the most you pay is your premium. With the upside potential, after your premium, there is no uh, limit. The only, as I said, the downside risk is what you pay in your premium. So you want to lower your premium, lower your risk, but yet you want to find those combinations that will give you pretty well unlimited profit potential. So again, when it comes to the cost of the future, the size of the contract plus the margin, with a premium paid out, it's just that, just a premium. And then the other good thing with the option is you have the right, but you're not obligated to buy or sell. You can just let it expire if you get a profit from that. So the margin requirement is just lower. The only thing you have to deal with is the margin, or sorry, the premium. That's it. One of the other things that people don't realize when it comes to the broker, if you do only futures, you are put at a point where if the futures does go against you, you will get the margin call from your trader. Usually, if you're only buying options, you won't have to worry about margin calls because you're not using margin. If you're selling options, is a different story. That's a different way of trading as well. And the ones only selling options are usually the large private agriculture firms like Cargill. They're selling the options because they have the know-how and experience and the resources to do that, as a large agricultural player like Cargill and whatever else. So continuing along with the hedge fund, or sorry, the hedging math, you can see again the different standard deviation, which is really the risk, the correlation between the cash price, the future price, um, and as well, you can measure it right down to the variance per unit basis. And is there a covariance or a correlationship as well? And then again, we can calculate the hedge ratio as well, and the portfolio return, the expected portfolio return as well. And then we could set an optimal hedge ratio and what would our optimal portfolio return be under these scenarios, and if we meet the targets that I've talked about as well. So again, what would our metrics need to be to achieve these goals? Let's say we need our initial cash price to be this, we need our put option price to be that, and what would our option premium be per unit for that future as well, if that's what you're taking on. So again, here, what we're trying to do is long cash position. We profit increases as the price increases with a put option. It provides a protection when the price falls. So again, if you're buying or speculating with options, or if you're selling an option as a, I always get the two confused, hedging versus speculating. And again, you can combine those two as well. So we find combinations to limit our downside while allowing upside potential. And again, that comes from these put payoff diagrams. That's why they exist. And continuing along, all these different scenarios as well. Uh, if we have a call option, what would happen? What would happen if we had a future price from a week ago, or a call option a week ago, so on and so forth, or a put option as well. And we can do present day, and we could also do a forecast as well. And then, of course, we can use time value as a measurement, and the gamma as well, which is measuring the time, sorry, as you move towards expiration. And we can chart that as well. It gets pretty crazy. A lot of simulation. And the funny thing is, you don't need to have a physical computer uh, rig to do this. If you're willing to pay from a cloud perspective, you can get access to cloud servers that will have these GPUs on board, so you could just load up your code, spin up the server through the cloud, do your test, and then walk away. So there's that advantage as well. So again, all kinds of different ways to value this, and blah blah blah. These theta, time decay, and it just goes on and on. Other things you can measure that a lot of people don't, as I said, don't pay attention to is intrinsic value. So again, when it comes to technical analysis, as I said, the only two that you really need is this: a simple moving average. Here you got a 5-day SMA on the closing price, and you can see right here you have your entry right here, your exit. It's the most reliable way to trade. Here, you just watch what's the 5-day moving average and the price, and you already know there's a very short-lived trade, and you're not going to make a lot of money, but just watching that. That's all you need. You don't need anything more further complicated beyond that. The other thing you want to watch for is the oscillation on the price change, and the number of days as well. And obviously, if you are in a entry point right here, and your, call it your RSI, which is your oscillator classic, moves up, that's your, could be considered an entry point as well, and enter into the market. But using whatever parameter you want on the period, we'll look back on the SMA or EMA or whatever you want, you can do that. But usually, the simpler the better. So that's all. That's the only thing you need to worry about when it comes to your technical analysis. So it's essentially just to help you outside of um, what you want to buy with an entry or exit. You can use these two sort of technical indicators to time your entry and exits, overlaid with all the other um, things I've already talked about from the option space. So what? So here we can analyze, let's say, a put option. What happens if the price declines? New price, future price, and what would the impact be, and what would our net return be? Okay, same if there's a price decline. So that's on a put option. With the price increases, obviously we can have this again, measuring cash price, future price, maybe having to measure the intrinsic value of the put. What would our net return be? And again, this is really important. Understand this. Put option expires worthless, but the farmer benefits from the higher cash price, right? So again, what happens if we have a future P&L over the last week? Buy price, CLL future, profit level. And again, we have our uh, combined scenario of a long cash with a put protection. And what happens if the strike price is this? And all that fun stuff. So again, using Greek analysis, we can use what would our risk-free, or sorry, what would our options provide us. This is using, again, Black-Scholes, and many firms have their own custom derivative models of from the Black-Scholes. There's a whole bunch of them. But again, we're just really using underlying future price, time expiry, risk-free, and the volatility, and we can measure what our projected out of the money profit would be at this strike. So our price could be this, and what would our delta need to be for that? So right here, we could use this as a key takeaway. Delta measures, again, the expected price change for every dollar in the underlying profit. So we'd be at the money. And again, this is important to understand that we're able to exactly measure. We're at the money when the delta closes at zero point 0.5, while out of the money option is lower detail. So here we can measure those deltas as the price goes up. And you can see here what happens on the option price as well. But yet you can see visually, you can see that as well. Again, this you won't find a lot of places will provide this for you. And that's why it's so valuable to know this sort of information is like, what would our delta need to be if the price is this? And what would our option price be as well? So we can measure that delta and then calculate what our projected profit would be. And a lot of it is simulating through this. So the put option, same thing. If our option price and what would our delta need to be in that changing underlying price. And again, same thing, option pricing dynamics for a futures contract where we have our underlying price along with our option price. And again, as the price starts to move up, what would our delta be, and visually seeing that. And I'm starting to learn what's measuring this length of this delta. It's the put call parity that measures that when you get it right. Again, we got more hedge math. Again, I don't need to provide this, but it's important information. Put option evaluation, assuming if there's a 5% drop in the futures price. Da da da. Here's a comparison. What would have to be? And again, this is the AI summary summarizing all this. For optimal price, higher strike price provides greater price protection but incurs a higher premium, or a lower strike price is cheaper but offers less protection. So again, right there, that's the AI stating that, right? So we can have a put option, assuming if we have a 5% drop in futures, high strike price option, with all the different measurements on her, specifically on her intrinsic value, expiry is worthless. What would our net return be? And then we get our key takeaway from that. High strike price provides a strong price floor, limiting losses during price decline. That's pretty impressive to know that. And again, we're here to measure, quantify, and qualify these calls using these tools available, knowing this stuff. That's why it's important to know it, understand the coding, and so on and so forth to protect you with, I keep saying, quantitatively, and to be able to qualify it as well. That's why these folks in the HFT shops get paid big, big, big dollars to be able to quantify this. If we have this scenario, what will happen? What would be the impact on our portfolio? And what can we expect on the net return? And, things that people don't evaluate. What would our intrinsic value be? Blah, 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 blah. So again, we can measure things like lower premium allows more profit, price rises, but significantly less protection if the price falls. Okay. So knowing this and put yourself in that mindset, you can build out these kind of tables to measure the high strike price, low strike with a premium floor price on the net return for a decline or an increase. Again, coming up with these scenarios. Okay. And then we can choose from that what would our best scenario be to build out a pricing engine with these targets in mind and our strike prices and the impact of it, and then be able to feed that back into an LLM and to be able to measure all your predetermined targets, all your execution, and be able to measure exactly what you want with your predefined targets and to minimize your risk. So if you have your put option strategy as well, and then be able to measure that. So we have different scenarios we can use for price declines, price increases as well, and that's pretty well it. Again, if you want to know more, as I said, go to our forum. I'll put the proper links in the description right here. Call for elite traders. I've covered a separate video of that. And again, this is summarized in less than an hour, which is still a lot of time as far as I'm concerned, but you can see the complexity of it, but you can see the reward that comes with it. And if you want to learn more, go to my Learn tab at quantlabsnet.com. Fill this out. I don't sell information. You can see how HFT shops are built out with C++, with that free ebook as well. And then go from there if you want to join our newsletter. Thanks for watching. Have a good day. Okay, forgot to mention this important part. So I mentioned the 39 reports that we have. I've shown you in detail the oil CL futures. We can also look at some of the more popular ones. Let's say oil and ES are the two most popular. So I want to show you the differences using the same data but different charting. One of the things I mentioned about was the volatility is lower in the ES. So that right there might be something that would be very useful for you. Again, you can see that the projected using REMA, the price should go up. Here's our usual hedge fund math, our implied volatility under all the different scenarios. If you need to know about the different, what would the option chain data look like? Again, we have our Greek analysis, da 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 da. And again, this is the important one that is helpful to understand the put call parity. You can see how it's much more tighter, and there's going to be more calls than puts. So it kind of gives you a general direction of where things are going. And again, this is simulated, but using real world option chain data, you can see um, the advantages here for even if you're trading at a high frequency level, you can use this to advantage. Okay, so we can look at our risk-free frontier, and then as I said, you go your heart's content combining the different payoffs and what type of options payoff you could use. I'm ripping and roaring through this as fast as I can. I've already gone into the detail, but I just want to show you the differences between the different option kind of strategy payoffs. Some of them are messed up, but I'm going to try to build some intelligence there. And again, we can go through all the arbitrage, all the hedging opportunities. We can see, again, the pricing boundaries we could set, which could keep you in your guardrails, if you want to call that. We can also calculate our gold area that we want to be within on both the put max or the put minimum, the call min max, and so forth. Again, using hedging effectiveness, I've gone over multiple times now, and it just gets very sophisticated very quickly. You may have a combination of this sort of thing where we have a futures price combined payoff both on a long cash position or put option as well. Be able to measure downside risk along with upside as well, and we just go through in detail what you need to be. Usual technical analysis is there. And I'm going to tell you something. If you watch me through Monday, the webinar on the ES, here's your buy. And I predicted it would be a short-term, short-lived opportunity. And there you go. It's very close to approaching. Yeah, start selling the gains that you would have. That's the beautiful thing about the SMA, along with your oscillation as well, where you know it gets a little overheated and start exiting your positions. If you were to follow the ES contracts or whatnot. Again, using hedging, arbitrage to maximize your trading option. Again, I've shown the overlaid with the delta. Sorry, this is delta as well, and understanding the relationship between the futures and the options. Let me show you another one with the gold, so you can see the classic difference between these. So let's say with gold, and there's a mini and the micro version of it. which is more popular for smaller accounts. And you go through it. Here's the price on your gold, and as it predicted, it did go down. Um, as of today, yeah, I mean this is pretty impressive. The option chain simulated detail, da da da. Again, and you can see why. Oh, one thing I need to measure is that's page 7. And again, here as you go through it, look at that annual volatility. I could put in the daily volatility as well to measure the risk, but here's the funny thing. The lower the volatility, the tighter the call put parity is. So there's less opportunity there from high frequency because, well, it's tighter because of the volume of people putting on positions to preserve their, well, basically hedge their portfolio against the falling dollar with a rising uh, gold price. Okay. So this kind of makes sense when I go through and look at it more and more. I just got to eke out more and more of the bugs, put more intelligence in the reports as well. And I'll put out some videos on the progress of this to showcase this. And it'll all be in my uh, forum post as well. And I'll put everything in the description of the video. And on it goes. Again, here, those boundaries, the gold zone, gold area to trade in. Yeah, it's very detailed. Let me pull up another one here. Let me I think LE, which is lumber. Again, this is uncorrelated. This is really good to know if you could find more of these. This one's been trading pretty good. I believe this is lumber. As you can see, a lot of traders are probably in it on this one. Um, and again, look at this overall annualized volatility, only 10%. I think this is one of the reasons why people are trading this more and more because it has such a low, like this volatility is lower than gold. Um, but you can see here the general trend since September is just trending up, kind of like gold, but with lower volatility. This is why this would be a classic um, instrument to trade in the futures because of the lower volatility and the general trend. Okay. This is one of those uncorrelated, doesn't matter what happens in the markets, be it with the U.S. Treasury, be it with dollar markets, cryptos, so so forth. And there's still some opportunity here to make money at a high frequency as well if you wanted to do that. But again, I need to verify that this data is valid. But you can see what I've already shown. I mean, it's pretty mind blowing where we're at, and people don't know about this. You won't hear about this in financial news like Bloomberg or CNBC, and all the different things that are presented to you, and the availability, on the tolerance, and setting the guardrails. If you want to do some fairly sophisticated trading, and the price is fairly affordable too, at a lower volume. And again, you can set your boundaries here. You can see your gold area opportunity. I could go on. And if you want to do a future overlay with a couple of option trades and be able to generate a pricing engine for this, that can be done using a AI for that. Okay, and again, you can see pretty close to have a buying opportunity as well, and the oscillator is still kind of within range where you might still have an opportunity. Again, put option hedging if that's what you want. Man, and you see, because it's a little tighter here, there's not so much gamma, but I'm still trying to understand that relationship as well. Once I figure that out, again, that's something good to know to explain. Let me show you one more um, that's unrelated. Let me see if there's OJ. This is an interesting one. Um, this is orange juice. Again, something you may not really consider. Volatility is pretty crazy here at 40, but this is what the appealing thing is. Question is, if you historically looked at orange juice, um, it's been hit, it's on a little rally. What happens if this rally continues to pass Bitcoin levels? Okay, and the arena is pointing of that momentum to continue, right? And now you know that you could probably maximize your profit potential here, um, despite the crazy volatility. But this might be a classic bottom to get a major upswing from. Okay, and again, you see there's a balance in the market with a put call parity, right? Risk. I need to understand this risk frontier thing better. And here you go with the payoff diagrams, being able to figure out which style of options you should take on. You see the difference here. Is it a good time to get in? Again, you got to suss all this out. That's why I need to help understand this. And again, you can see that golden opportunity. And here, there is some balance in the market, supposedly between the call and the put. And again, you can measure if there's an arbitrage at all and do all your scenario role playing as well through these kind of reports and feed it back into a AI to develop your pricing matching engine. And again, here, this is the good thing about these kind of analysis. Here, you can see your buy opportunity was here. Might have missed it already. And as these two tighten up between the 5-day moving average and the closing price, that's the close of that opportunity. Here, you can already see that the maximum opportunity might have already happened because the oscillator is starting to drop. Okay. So that's important to know on the timing of that using an oscillator. Again, if there's still an opportunity to put call options. And the thing is that as a smart money trader, the um, the well, I will say not smart money traders will dump in now because they think it's an opportunity. Anyways, you can see that there's lots of opportunity here, just showcasing lumber or orange juice as well, and you have all the available other data as well. I'm gonna leave that here.